Hey, this is Alex from Voyage Financial, and in today's webinar, I'm going to be talking specifically to our medical clients, our doctors. I'm going to be telling you about why you are so special in the lending space and why you're a bit of an outlier compared to pretty much any other industry that any broker deals with. So what we're going to be going through is LMI waivers at high LVRs, and if that doesn't make sense to you now, then it will in about 5 minutes' time. What the different income requirements are for medical professionals compared to someone else in another industry. Dedicated credit divisions that we can access for you, the better interest rates and fee waivers that we can sometimes access for you, private banking options, and then available lenders and limitations. And the outcomes that I'm wanting to get to are really understanding what you can access when it comes to lending for property, either your own home or an investment, understanding some of the basics of lending like LMI and LVR, understanding what a 95% loan is, whether you can access it, and the answer there is yes, you probably can. Understanding that it is really common in the medical space that there is a smaller lender pool to access property with a lower deposit, but there is actually no penalty in terms of rates or features or fees or anything, and that 100% lending, if you want to go there, is possible. All right, so let's get stuck in. I don't know why I've got that sitting there. Let's go to this one. All right, so why are doctors so special? So in a word, two words really, you're low risk. Doctors are amongst the highest earning professionals in the country, and there's actually a separate presentation on this called Financial Management 101 for Doctors. Highly, 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 highly recommend you go watch that. It's going to explain to you a lot about your career and your colleagues and the journeys that you go on and some of my experience and stories. Fully recommend you go watch that. It goes for about 45 minutes. So you are one of the highest earning professionals in the country. From basically year one, you're earning more than the average Australian. So as an intern or an RMO, PGY 1 or 2, you're going to be earning, with some overtime and penalties, etc., probably around $95,000, give or take $5,000 or $10,000. But you're still above the average Australian income. And not only that, you're starting there, but it's also really stable. It's also increasing. And although you do move around a lot, you can almost earn as much as you want. Like the sky's the limit. As long as you're willing to work for it, you can earn crazy, crazy, crazy amounts of money. And we see PGY2, PGY3. I don't necessarily recommend that you do this, but they earn stupid amounts of money because they're willing to go regional, they're willing to go locum, and they just commit themselves and they earn bucket loads of cash that they then start putting into other investments. You can also then lead into commercial lending. There's lots of special commercial lending that is available for doctors and no one else, like 100% commercial lending, which probably doesn't mean much to you, but is like unheard of in any other industry. From a lender's perspective, you're a really attractive borrower. You earn lots. Your income is really stable. Your career progression is pretty much guaranteed. You're likely, as you move into your consultant years, to need all sorts of additional lending, like the commercial lending. You want to do all sorts of, you want to purchase nice fancy homes, you want to purchase nice fancy cars. And so for a lender, like to get their claws into you is a really attractive proposition. And the earlier they can do that and establish a relationship, the better. So lenders off the back of that are going to offer really good policy and really good rates. Now, not all lenders will, and I'll explain that as well. But lenders are going to offer, good policy with good rates. So LMI waivers at high LVRs. Have I got an explainer for that? Or do I need to explain that now? No, okay, that is explained in the next slide. You've got different income requirements. So compared to the normal population, like me, for example, if I'm trying to get a home loan, I can't access what you guys can access. You're going to have LMI waivers at higher LVRs, and I will explain that in the next slide. You're going to have a different set of income requirements, especially if you're self-employed. You're going to have dedicated credit divisions. You're going to be able to get better fee rates and fee waivers, and you're going to be able to access private banking basically from the very beginning if you want it. All right, so LMI waivers and LVRs. So lenders, just so you understand, like lenders aren't lending you money to buy a house. Like it's really, it's a complete switch from what you're used to thinking about. But lenders are not lending you money to buy a house. They are lending you money to make money because they know that they can charge you interest. And what they're doing to ensure that you don't lose money, what they're doing to ensure that they don't lose money is taking an asset, i.e. the property that you're buying, worth more as a security in case you actually stop paying. So it's really important that you understand, maybe not really important, it's interesting to note that, you'll see ads about lenders lending you money and like you buying a house and buying your dream home. They don't care about any of that. All they're doing is they're trying to lend you money because they know that it's a product that they're selling you. They can earn interest off you over time, and in order to ensure that they don't lose money in case you stop making repayments, they're going to take an asset that they can sell in case you can't pay. So for the average punter, like me, a plumber, a lawyer, maybe not a lawyer, we can't go as high as medical for lawyers, but for the standard populace, we'll say a lender is going to be comfortable taking an asset worth around 20% more than what they're actually lending you. Why? Because if you stop paying, then the lender can basically fire sale that property and recover what's owed and pay legal fees. So to put some concrete terms around this, let's say that you found a property for $1 million and you've got a 20% deposit, so that plus stamp duty and other costs, they're going to lend you $800,000, and that $800,000 is 80% of the property that you're actually purchasing, of the value of the property. So that the gap is 20%. If you stop making repayments on the $800,000, like you're in an accident or you just can't be bothered, you stop making the repayments, they're not making money on that loan anymore. They follow you up, they chase you up, they have to take you through the courts to actually get that property sold. Let's say they sell and they just want to get rid of this thing. They just want to make sure that they're getting the interest that they were owed. They're wanting to make sure that their legal fees are all covered as well. They can fire sale the property and they can drop the price. Let's say it's still worth $1 million because the market hasn't moved. They can just say, look, it's going to be sold for $900,000 because we just want to get rid of it. Obviously, that's going to be snapped up because it's an asset that's undervalued. They get their money back, they get the interest back, they get their fees back. They're not really trying to make a profit on it. They just want to make sure that their money comes back. But what happens if you don't have as much? So you're still wanting to buy for $1 million, but you don't have $200,000 to put in, but you do have $50,000. And again, we're ignoring stamp duty and other costs, but you've got $50,000. So now they're having to lend $950,000, and all of a sudden that gap is only sitting at $50,000, i.e. 5% of the $1 million that you're purchasing for. They're lending you 95%, and all of a sudden their risk is much, 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 much higher. So if you stop paying, they have to sell. They can't sell. Maybe the property market has dropped a little bit. They only sell for $900,000. They haven't covered the interest. They haven't covered their legal fees. They're not even getting their money back. So for most people in that situation, where there's less of a deposit that you're putting in, the lender is going to demand, number one, that you pay a higher interest rate, but number two, that you pay something called lender's mortgage insurance, which is basically the bank's insurance premium to ensure that if the property, if they don't get their money back, then the LMI kicks in, they get their money back, and then quite often LMI is actually going to come and chase you up because that's the way it works. So the loan-to-value ratio is higher than 20%. It increases the lending risk. To compensate, they'll charge lenders mortgage insurance, and they won't do that for medical. So they understand that medical is a pretty safe bet. You're always going to be employed. You can always work. You're never going to be in an industry that is subject to economic downturns or to pandemics, let's say. You're always going to be employed. There's always work. Doctors are always in high demand. And so they're willing to, and they want to get you on as clients already. So they're willing to basically take the cost of that LMI and take that risk themselves because they know that you're very unlikely to ever default on your loans. So lenders and insurers will set their risk levels in bands. So you might have 60% band LVR, 70%, 80%, 90%, 95%. The higher the band, the more the risk. And as I've said, lenders are willing to forego lenders' mortgage insurance at higher loan-to-value ratios because of what we've discussed, which is that you're a pretty safe bet. You're not going to be defaulting on your loan anytime soon. Now, some lenders will have that. They're willing to offer you a concession on the lender's mortgage insurance, or they're willing to allow you to go to 95% without basically penalizing you with mortgage insurance or with any higher interest rates because they're trying to attract you as a client. So some lenders, but if we actually have a look outside of just the LVR, there's some other policies that some lenders will offer that put you in a bit of a special case as well. So some lenders are going to bend the income rules to lend to you. So for example, they might offer you a 1 year or an even 6 months of self-employment. So let's say you've just gone into private practice, or you've just stepped out of hospital and gone into clinic, or maybe you've just gone into some locum work. For most people, let's say if you're you can see there. Let's say you're a plumber and you've done your apprenticeship, you're working for some other guy, and you're like, you know what, stuff this, I can do better on my own. That plumber goes out on their own, and all of a sudden they've got to build like an entire business. They're now self-employed. They've got to build an entire business. They've got to find clients. They've got to determine their business processes. They've got to buy a van. They've got to buy tools. They've got to potentially hire staff. Like there's a huge process for them to build that business. And so lenders are going to say, typically, for most people, for everyone, if you are self-employed, there's risk that comes with being self-employed, and the only way that we're going to lend to you is if we can see consistency in income over years. So let's say 1 or even 2 years, we want to see consistency in your self-employed income. Now compare that to a doctor heading into a clinical practice. You're sitting down in an office or in a clinic or a practice that's already there. Technically you're self-employed because maybe you're on billings, but the clinic's established, there are clients, there's patients coming in every single day. You're just seeing those patients. Maybe you've still got to build up your client list a little bit, but everything is there provided for you. Technically, you're still self-employed, but you're not taking on nearly as much risk as the plumber who's starting his business or her business from scratch. Most lenders will just treat you the same as the plumber. Some lenders, which I'll explain a little bit later down, will actually understand, like, your situation is different to the plumbers. You need to be treated differently. And so what they'll offer is, maybe even 6 months of self-employment, or even with some lenders, the day that you turn self-employed, if we know roughly what that practice is going to earn, or if you come into billings, we can sort of estimate it. Potentially we can get away with you being like a couple of days in self-employed, or maybe if you've gone locum and you've got a contract, technically self-employed because you can contract out to multiple different places. We're going to treat you differently, or those lenders are going to treat you differently from someone who's signed a contract, maybe signed a contract, a self-employed contract as an engineer, like just contracting their services out. So the situation is very, very different. Lenders will treat you differently. Not all lenders, but some. Lending against income is also a thing. So if you're a consultant, we can actually use your consulting income as a source of security. So that's a bit niche. Don't worry about that. If you're a consultant and you're looking for some extra borrowing, come and have a chat. No minimum time frame for casual work. So if you're working casually, then basically we can say, well, day one casual. Obviously, casual income is by its nature pretty variable. Most people in other industries are going to need some time to establish a pattern of consistent work. We don't necessarily need that in the medical space. Lending against future income is a pretty massive one. So obviously, if you're a hospital-based doctor, still in your sort of PGY1 to PGY10, you're on a very certain path with very set income steps. We can actually lend against income in the future, and we like to not use this if we can. But if you're just needing a little bit of extra income, then we can do that. And also, like, another option is a waiver of soon-to-be extinguished debts or expenses. So if you've got a HECS debt that's dragging your capacity down by quite a bit, but we know that with your pattern of work, you're paying it off at a rapid rate, and it's going to be going in maybe 1 to 2 or 3 years, it's unfair for us to base a 30-year loan term on this massive servicing drag that's actually going to be gone in maybe like 12 months. So most lenders will include that and assume that it's part of your 30-year loan term servicing. Some lenders will say, no, that's silly. And they'll only do this for doctors, but this is silly. Let's actually assume that doesn't exist. And maybe we can set the loan interest only for a year or so. All right, rates and fees. So lenders can offer better rates to doctors. Not always, but they can do. It's best to chat to us. If you have a look at my video on interest rates, you'll start to understand why sometimes rates differ between individuals, between doctors, scenarios, etc., and times of the month. Rates and fees will depend on a variety of factors, so go watch that video. Specialised credit departments and private banking. So the majors especially, because there's such a differential between standard and medical lending, like I've just described with self-employed income, for example, some lenders will actually have entirely separate credit departments just for medical professionals, so they really focus on it. And they're more open to sort of non-standard scenarios because they know that, the doctors, they want you on board. They're willing to sort of bend the rules a little bit more if it means getting you on as a client and you borrowing lots of money. There are also bankers who better understand medical income than others because, medical income can get quite confusing, especially if you're in private. And I've seen some like crazy, ridiculous private arrangements. Allowances, professional development, public versus private, locum, switching contracts, new ABNs, different hospital arrangements, complex private agreements. Like, it can get quite complex. It's quite a niche sort of specialty space to be in. And some brokers are going to understand medical income better than others, and obviously we at Voyage are included in that. So I think this is my last slide. So which lenders? The lenders that sort of will specialize a bit more and more lenders are opening up to medical income because they understand that it's a pretty good space to be in. But just to go if we're looking to borrow 100%, then 100%, we're pretty much looking at BOQS as really our only option in the space at the moment, mid 2024. You're still going to need to pay stamp duty. So BOQS used to cover stamp duty as well. So you could borrow even more than 100% of the value of the property, like 100% LVR or 105% LVR. You can't do that anymore. You're still going to need to pay stamp duty. The way that they structure it is that anything over 90% is a personal loan, and that does attract higher rates and a shorter loan term as well. So it can be a bit more of an expensive option. Ideally, we'd get you to like a 95% loan to value ratio, but 100% is possible if you're wanting to go there. At 95%, so if you're looking to purchase and you've only got a small deposit, then BOQS is an option, but we also will probably have a look if you can scrape together 5% plus stamp duty and other costs. ANZ, Westpac, CBA, NAB. So it used to be really only Westpac in this space. Then ANZ sort of came in, and then CBA and NAB have come into that space as well. We can lend up to, or they will lend up to 95% on purchases. They do have different rules for loan size, interest only, investment loans, etc. So some of those big four are better in different spaces than others. This is, we're getting quite deep in the weeds policy-wise, so definitely have a chat if you're looking at borrowing at 95%, because they've all got different rates depending on what you're looking at doing and different rules. If you've got a 10% deposit, then all of a sudden, so 10% plus the stamp duty, then all of a sudden a bunch of other lenders come into play, like Suncorp, Bankwest, St. George, HSBC, Auswide. They will all offer 90% loan-to-value ratio loans with no mortgage insurance. So that's the key here. All of these loans don't have any mortgage insurance attached to it. So it's going to be a saving of potentially $15,000, $20,000 or more, and no penalty on interest rates either. These lenders will, so ANZ, CBA, Westpac, NAB, they will typically offer you a 95% interest rate at an 80%, at an interest rate equivalent to what they would offer at 80%. So any other person at 80%. So they don't actually penalize you for borrowing more and for taking on more risk. As I said earlier, normally interest lenders would charge you more, i.e. in the form of a higher interest rate, because if you're borrowing more, it increases their risk. But they won't do that for doctors. Typically, those four will offer the same rates that they would have offered you had you had a full 20% deposit. Suncorp, Bankwest, St. George, HSBC, Auswide, there are more starting to come onto the market as well. Sometimes they will actually penalise you with a higher interest rate. Not always. Sometimes it depends on the lender. It depends on the time of the month. It depends on a variety of factors, but that's something to keep in mind as well. And they will also have different rules for owner-occupied versus investment. So typically, for owner-occupied, lenders see that as less risky, and so they're willing to offer maybe a 90% no lender's mortgage insurance loan for doctors for owner-occupied, but not for investment properties. So there's lots of sort of like nuances here. Basically, book a chat on our website and come and have a chat to one of our brokers. We'll tell you exactly what the situation is at the time. We can talk through your options. We would love to have a chat to you about how to purchase your first home or an investment property. We can take you right through the process. You'll see other videos about what we do, why to use a mortgage broker. Have a look through our website. We've got some pages dedicated to doctors as well. Have a chat to your colleagues. Have a look through our reviews. You'll see a bunch of doctors and your colleagues in there as well. We'd love to help. You'll be dealing with me or one of my brokers. We've also got financial planning involved as well. I'm going to stop this before we get to 20 minutes. And yeah, we'd love to have you on board and hopefully talk to you soon. Thanks.